Okay, so in this video, I'm going to be doing ratios, right? So ratios. Now, ratios, there's quite a bit of ratios, but the most common they ask is your profitability ratios and your asset management ratios. Now, if you critically think about it, why do they always say those ratios? Is because normally in a question, they'll ask you to do the dew point analysis, right? Or identity. The dew point needs some ratios from profitability, some ratios from asset management. So they like to already be done in the previous question before that. So if you really think critically, most likely they give those ratios to you. They want you to do that. So profitability ratios and asset management ratios, which are only these ratios. Okay, remove this accounts payable. We no more use that. You just learn that, right? Thoroughly good, very good. Promise you, might come out. And still learn all your other ratios too. Still learn it. They can still ask all the other ratios. But what I'm trying to say, these are more important because most likely they will ask this. Okay, so let's start. Analyze the profitability and asset management, right? Of 2022 and 2023. Now, these are comparing the years of the same company. Sometimes they might do different businesses. So this is LTD, some monkey business. This is LTD, some rabbit's business. So comparing two businesses, comparing 2 years, it's actually the same thing. But obviously your interpretation will be different. Like you'll see one business you performing better than the other one. Over here you'll see 1 year you perform better than the last year. So like it's different, but same thing. Okay, so how do you do this? Now, in the exam, you must do a table. I promise you. See, your examiners they get irritated. If you're just gonna put your percentages all over and all that, it's gonna be a mess, right? So structure it so when the examiner looks at your work, she gets hyped. So like she'll mark you good. Cause this whole thing here, I mean, she'll have to judge and mark. It's like an essay question, right? So let's start. Okay. So there's only four profitability ratios. So I'm telling you, just learn all these four. You got your net profit margin, gross profit margin, return on assets, and return on equity. Those are your profitability ratios. They won't tell you that in the question. So you have to work that out. Now, are we going to be given these formulas in the exam? If you look at the instruction sheet of all these past tests they gave, it says you will get a formula sheet. Do you trust that? Yeah, a little bit. But like I would actually memorize it. I memorize it. But like they say that they give you, and they do give you. I've seen in the past paper. So yeah. But you have to know what goes in what like type of ratios go into profitability and so on, right? So just memorize it. So profitability ratios, you got net profit margin, gross profit margin, return on asset, return on equity. Memorize that. They won't give you that. These are grouped under profitability, right? I'm going to tell you now in the answer what each one means, but let's calculate it. Net profit margin. Anytime you see margin, it's something over sales. So net profit margin is your net profit over sales. We're working with 2023. So 1 second. So, 1 second. Net profit. So 2023 we're working with. So net profit, there we go. This amount over the sales amount. So 115,200 over 780,000 is equals to, and they don't show you your times 100, but in your calculator you must show the times 100. You get 14.77%. Now, I don't think over here they will, you in your working when you do your exam must show 100 because they didn't do this in memo. So in the exam, see in the calculator you just put this amount, you'll get 0.1477. But some people like me, we do not know what that in percentage form, so we just times it by 100, but don't like show it, you know what I mean, in the working. Okay, now that's easy. It's 2022. I'm not going to do 2022, that's the same thing I'm doing. Let's see. The next one, gross profit margin. So you take your gross profit over here over your sales amount. So 340,000 over 780,000. There we go. Times 100, you get that amount. Return on assets. Anything they say return. You're going to take your net profit after tax over something. Return on assets. Net profit after tax over assets, total assets. 115,200 over 46. 1 second. Over 775,800. Yeah, same. Times 100. Done. So return return on equity, net profit after tax. As soon as you say return, net profit after tax, over your total equity, can you see total equity is 376,000? Okay, why I'm working with 2022? It's 2023 years. This 115,200 over 462,080. There we go, done. And then you'll do for 2022 also, same as how we did 2023. I'm not going to do it as the same thing I'm doing, huh? So don't forget that you're doing a comparison. And then we're done. Now, all your profitability ratios, if it increases, it's good. It means it's good. So 2022, this is the past, this is now. So 7.60 and now it's 14.33 each. 778, that's good, man. Now, that's extremely good. Gross profit margin 35, 43.8 increase. Very good, very good. Return on assets 7.28, 14.85. Very, very good. Return on equity 12.24. I mean, we're doing good, man. Can you see how all these are almost double? So in your answer, you can also say it's almost double. So how do we comment each one? So, okay, so there we go. There's tell you here, there's all improvement. So if most of the profitability ratios improve from the previous year, say it in your first question introduction, most profitability ratios have increased from the previous year. They're almost double. Say what you're like looking at, they're almost double. The return, okay, so alright, let me tell you what return on assets and return on equity, what it measures. The return on assets, right, basically tells you how efficiently you're using assets in a business, how effectively you're using it. It makes sense. You make your profit and you got assets in a business. So how well did you use your assets to make the profit? That is what the ratio is saying. The equity ratio is how well you're making the profit in the business with your equity, right? Your owner's equity. Owner's equity is like people who give you money for shares and all that. How well are you using that to get your profit? So the way they say the return on investment in assets and return on shareholders increased in 2023. These indicate that they were efficient in using assets and shareholders' equity to generate profit. There we go. So as soon as you see the word, it's efficient. So return, assets, equity, it's efficient. So it's efficient in using the assets, using the equity into making our profit. How do we know to say into making our profit? We look at the formula. Net profit after tax over your assets for asset return on assets. Return on equity, net profit after tax over equity. So you know your net profit is like your main thing. So to increase your profit, you're using all those efficiently. If it's an asset one you're doing, it's using your assets to make your profit efficiently. There we go. And there we go, yeah. And then now what's profit, net profit and gross profit margin? Okay, easy. Your net profit margin, the way I like to see the way I like to definition this is, your net profit margin shows how well the business had controlled its expenses and cost and has made a profit. It makes sense. Your net profit margin is your net profit over sales. No, sorry, it's your net profit margin. Is it your net profit over sales? Yeah, net profit over sales. So it's trying to tell you is how much of your net profit you're getting from sales. So obviously, the lower the cost, the lower the cost, the higher the profit will be from the sales. Makes sense because you're deducting all your costs and income statement. So yeah, the net profit margin basically says how well the business controlled its cost in order to make the sales, right? Your gross profit margins. Gross profit is sales minus cost of sales. You must only think in that direction. Gross profit margin says how well, or it shows basically what is left over, or the percentage of what is left over per rand of the sale after you paid for your cost of sales or after you paid for your goods. So, in a simpler way to understand it, it's basically saying how much of sales you got left over after your cost of sales. So the higher the better, that's the gross profit. So the profit margin ratios, those two, GPM and NPM, that's the same thing over here, increase, showing the firm was more efficient in managing its operations was more better in controlling his operations. Same thing, controlling his cost. Operations mean cost, generating operations, efficiency. Anything that will do with this profitability is efficiency. Don't forget that it's not effective, it's efficient. The increase in GPM, so gross profit margin, indicates the sales increase at a faster rate than cost of sales. It makes sense. If that increased the ratio, that means there's very low cost of sales. That means sales must have increased a lot at a faster rate than cost of sales. AWD, the business name is that, was more efficient at converting sales into actual profit. So that was your net profit margin. They're very efficient to making your sales and like basically making your net profit out of it. So remember in this things, right? You can BS, huh? Don't you can do your own things as long as it makes sense. You don't have to follow these memos, these exact answers. Tip, write a lot. Okay, they won't mark you down for writing a lot. I mean, if the examiner is in a bad mood, yeah, probably, but I don't know. But like, I would probably write a lot, but as long as it makes sense. Okay, so that's the profitability ratios. Now the asset management ratios. Inventory turnover accounts. Now see here, they don't in what we're doing now, instead of accounts receivable, we say our average collection period. Yeah, so remove this and put average collection period, total asset turnover, and erase accounts payable. So we only have inventory turnover, average collection period, total asset turnover. We only have those three. Yeah, so right, so let's start. Your inventory turnover, huh? How you work it out? Cost of sales over inventory. Cost of sales 440,000 over your inventory. There we go. 440,000 over 127,600. And the answer will be times. Now they put actual times here, but it's actually TIMES times. So that means the inventory went out of the business and got replaced 3.45 times. So if you picture a business and if you have a milkshake sitting there, it's going to get sold and it's going to put back in the shelf the new milkshake. Get sold and put it back in the shelf the new milkshake. 3.45 times means about 3.5 times the milkshake was put back in the shelf. That means 3 times it got sold in the business. So the more higher this is, the milkshake got replaced back. That means the more sales, right? The more good, higher stock turnover, higher the better. Don't forget that, huh? So obviously that's inventory turnover. Your accounts receivable, your trade receivables over your sales. So trade receivable, now remember this would be called what? Average payment period. Average payment period. That's what we do now, right? Average payment period. So trade receivables over your sales. So trade receivables over your sales. 1,400 over 780. Perfect. But you say times 365. Now, they even, times 365 because you want the days. So your average collection period is always in days. 54.94 days. What it means? It takes 54.94 days to all those people who owe you money, the debtors, to give you your money, basically. So all those people who owe you, who took credit sales on credit, they took on debt, right? They owe you money. So how many days they give you? The shorter the number, the better. The shorter the days, the better, because you're getting that money back. This I said leave out. We're not doing that anymore. Total asset turnover. Now, total asset turnover is different from return on assets. Don't forget that. A total asset turnover is your sales over your total assets. Your returns on assets above was your net profit after tax over your assets. So this is the way I see total asset turnover. Turnover means sales. So sales over your total assets. So 780,000 over your total assets. There we go, 775 to 800. And that will be times, right? Times. So 101 times. So total asset turnover. Now what it means, okay. Inventory turnover, I told you how many times the inventory got replaced in a business. The higher the better. Accounts receivable is how long it takes your debtors to pay your money back to it owes you. The lower the better. Total asset turnover means how efficient you use your assets to make the sale. You see, your asset return above the calculation was how efficient the asset was used to make the net profit. Now it's how efficient the assets used to make the sales. So very easy, because you just look at the formula. You got sales above, you got asset below. So how efficiently you use your assets to make your sales, right? The higher the better. The higher the better. So if you look at the comparison here now, last year was 4.93, this year 3.45. So now it's less, that means it's better, good. Turned over inventory faster compared to 2022. Increase in inventory turnover also means there was no obsolete inventory. Because think about it, obsolete inventory means inventory just sits in your business, does not get sold, no sales. So if inventory is coming out of the business getting replaced, so sales. There's no products in your business that are obsolete. Every product is good, they're selling, that's good. So you can say that. The current payment period, that what we call it now, is slightly longer by a day. 53.84, now it's 54. So it increased by a day. So this is bad, right? So it takes that amount of days to collect from its customers, right? It's higher. So now it's bad, right? A day is quite long to remember that, huh? Just ignore. Total asset turnover slightly increased, 0.96101, indicating more efficient using assets to generate sales. I told you that. Efficiency. Don't forget that when you're doing this whole thing, ratios. Efficiency in using its assets to make its sales. And that's done, right? And now we're gonna do the next question. B. Use the dew point identity. Okay, so this dew point identity I'm gonna do in a separate video because it's a major topic, like 10 marks too, and like you'll understand it better if I do in a separate section. So yeah, so in the next video, go find my video on return a dew point. Alright, I'm gonna continue.